Hello, good evening, everybody.
Good
Hi, Alvin.
evening. Hi, Benny. Good evening.
All right, my internet is good enough.
Okay, sorry for the delay. Yeah, we're having some internet problems.
Yeah, if you think that time is the best, think twice. Yeah. Anyway, guys, thank you for joining us tonight. Okay, we have basically this event is an educational webinar brought to you by Bursa Malaysia-𝑖, right? And of course, the market has been really, really hot in the past 2-3 months, right? Ever since the MCO started, and I'm sure that a lot of people was wondering whether the market can still be invested or not, all right? Because a lot of stocks have already gone up. People asking whether whether they can still invest, they can buy shares at this point of time, right? But so today, we have Alvin with us today. He's going to basically share with you how to build a sustainable, consistent portfolio that generate the returns that you want, right? Especially a portfolio that suit you. Okay, so he's the master of value investing, so he's the best person to actually share with us today, and that's the reason why we have him today. And of course, this is actually the last session for Bursa Malaysia-𝑖 webinars, right? We have run a series of already 6 webinars altogether. So if you missed it, you can go back and check our recorded live sessions on Wednesdays. All right, so we have 6 sessions altogether. If you want to know more about what do we mean by Sharia-compliant investment, right? So of course, today we're going to talk about building a portfolio, building a Sharia-compliant portfolio, and how you can still build a portfolio even right now. All right, so that's why we have Alvin with us today. Before I go further, if you can hear and see us clearly, can you just type yes in the comment section so that we can know that we are actually okay to go. All right.
Yep. I think hopefully they can hear us well.
Yeah. So hi guys. Hi Team Wong. Hi FCO. Caroline, Mark, Jason, Adil, Daniel. Thanks Daniel. Thanks Pang. So we are good to go.
Great.
Right, so today Alvin, Alvin will do most of the talking. So I just sit down and listen to him. And of course, I will take your questions. Right. So if you have any questions at all, please just type in a comment section so that I'll bring it up after Alvin finish presenting. All right. So guys, I hope you enjoyed today's session and hope that today's session will be beneficial for you, especially for those who have not built a investment portfolio. Alvin will basically share with you, and there is no best time to start an investment portfolio but right now. All right. So over to you, Alvin.
All right. Thanks, Benny. Welcome everybody. I'd like to also give my sincere thanks to Bursa Malaysia-𝑖 for sponsoring these educational segments, right? So I guess they also want you guys to make sure you guys are informed investors, right? Of course, today we're going to be talking about setting up a portfolio. This is very much an educational segment, but of course, if you guys have any questions, I am very happy to answer any of them. Yes, retail participation, I think, in a very, very long time has actually surpassed institutional investors. Well, I guess no better time than to really learn about informed investing and to make sure we're not speculating when we are investing. All right. Okay, so we're gonna get started now. A very quick disclaimer: this is very much for educational purposes. This does not constitute a buy, sell, or hold, or whatever call. Do make sure investments obviously come with risks. Decision ultimately will be yours. All right. So my goal today is to hopefully give you guys a little bit of insights about Sharia investing, and also if you are building a portfolio that you want to be Sharia compliant, then these are a couple of steps. Of course, even if you're building a portfolio that may or may not be Sharia compliant, these techniques have helped me create a portfolio. I hope you can also help you create a better portfolio as well. For more information about Sharia stocks, SC actually publishes on their website. The list is reviewed every 6 months in May and also in November. So you can actually kind of see and download all the list of stocks. I mean, you can download all the list of stocks, and every 6 months, SC will actually publish this PDF file. You can just Google SC Sharia list, and what they've actually done is actually done a very good summary, right, of the total number of listed entities and how many of them are actually Sharia compliant, right? So as of May, there are a total of 900 listed companies, and what they've actually done is actually split it between consumer, industrial products, energy, construction, transportation, logistics, property, plantation, technology, utilities, financial services, healthcare, telecommunications, SPAC, closed-end funds, right? Now you're going to see actually on the right-hand side here that most sectors have between 70 to or at least 75% on average and above Sharia compliant stocks. So which means of the whole total market of 900 stocks, 697 of them are actually Sharia compliant, right? Now, what is interesting to note is this: of all these major sectors, if you look at financial services, out of 34 companies in the financial services sector, only 3 of them are actually Sharia compliant, right? And if you look at the 3 companies, they are BIMB Holdings, which is Bank Islam. Of course, you have Bursa Malaysia, and you have Sharika Takaful, right? So if you're gonna look at funds that actually do invest in Sharia only funds, in terms of financial services, these are the 3 that they are allowed or are given that mandate to invest in, right? So this is an interesting space. Of course, if you add another 1 or 2 stocks in there, if they're good, you might see some Sharia compliant funds that may be interested in these companies in the financial services sector. All right, but generally most of them are quite well covered, right? Most of them are above 75-80%, right? Okay, now coming back to investing, right? Now we know the market is extremely hot. I mean, hot is probably a understatement. Extremely vibrant, right? I would say from 6 months ago, and we're seeing a lot of retail activity meaning people like you and I who invest in the stock market on our own are considered retail investors, right? Now I just want to bring everyone back to what investing is. You can either choose 2 paths really to make money, either to speculate or to invest over the long term, right? If you look at if you look at on a path of going into speculation, you have to understand that there are risks that carry on both sides, of course, right? But I think you have to be very clear that if you're getting the market, are you building an investment portfolio or one that is speculative in nature? All right. One of the key differences would be this, right? If you're speculating, you're going in and then you get out when you make a profit. Or of course, if it goes against you, you want to cut losses, right? That's pure speculation. And maybe speculation may not be may seem like a dirty word, but really it is speculating. You are speculating whether the price will go up or go down, right? The other side of the coin would be really to invest, right? Meaning that you are investing in businesses, right? And the idea here is that you want to grow your wealth over the long term. And the whole idea today is I'm going to focus a lot more about the investing part of the journey. What you actually need to do if you have that investor's mindset, which means that you buy over the long term, you invest over the long term. Of course, when stocks get cheaper, you don't want to accumulate more. Of course, when they get overvalued, you want to take some profit, right? So you just got to remember which path that you're taking. I think the most dangerous thing that anyone can do is that they go in thinking they're speculating, but then when prices come down, they start switching their strategy. You say, now I'm a investor or long-term investor, right? And I guess this is a surest fire way to actually lose money, right? So when it comes to risks, when it comes to stock market risks, there's really going to be 2 risks that you have to look after. The first one is known as your capital at risk, right? Which means that is it a good stock or is it a bad stock? The second risk that you have to also focus on is actually timing. Ideally, in an ideal situation, you want to make sure that your capital risk is low and your timing risk is low, and that will give you an ideal. But that's very theoretical, right? Looking at the existing market situation, it almost seems that everyone is almost ignoring the capital at risk. Meaning, we see a lot of companies that almost continuously for the last 30 trading days, they go up on 2-3% every single day, right? We just have to remember this, right? Can the company improve its earnings 2-3% every single day, right? So some prices may be reaching what we call the stratosphere, and a lot of retail investors tend to ignore this capital. But here's the biggest take to this, right? In the long term, it will all eventually fall back to those fundamentals, right? So meaning in the short term, prices can go up, but in the longer term, they can't be held up with weak fundamentals. Okay, so which means that if your company's not, now it seems that whether your company makes a profit or makes a loss, it doesn't matter. The price will still go up, right? So we need to be sensible, right? When we're looking at investing, right? However, I do want to add that, my own personal view is that, a lot of stocks have gone up. There are also a lot of stocks that actually have not moved, or actually quite laggard in nature. So to say that, there's a lot of activity, is very vibrant. My personal view is there are still opportunities out there. Of course, you just need to keep your eye out and look out for it, right? So there are still opportunities, right? But it seems as though everyone is focused only on a few sectors at the moment. Now, so how do you actually manage your capital at risk? There's really going to be 4 things that you're going to make sure you get right, okay? So which means that you need to, of course, buy the right stock, which is your capital at risk. Price is very much timing risk. Buying and selling is also very much timing risk. The quantity, and this I think is probably the most understated part of investing, is that everyone's just looking to find what stock to buy and what stock to sell, right? Or more commonly, what stock to buy only. Nobody ever asks when to sell stocks, right? The quantity part is often ignored, right? And this is where we're going to talk about portfolio, because how much money you put in per stock, depending on the risk profile of the stock, that is going to be largely dependent on 2 things, which is very much your portfolio strategy, and also what is your capital at risk, right? So remember, if you buy a good stock that turns bad, you have to understand that that's not in your control. The only thing that's really in control that you can really actually manage is the buying, selling, and really the quantity. All right, and the whole idea behind this is very simple, right? The higher the risk, the lower the quantity. All right. Of course, the higher the risk, you are also expecting a higher return. Okay, so remember that your capital at risk not just lies with the stock, but also how much money you put in that specific stock, right? So I'm going to give you guys a very quick sort of, an illustration of what can happen. So I have a stock price that's gone up $1 to $3, right? So what you're looking at is a 300% return, right? Now, if an ad you actually was able to hold on through this period, right? You're actually going to see a 300% return, assuming that happened. But if you only allocated 2% in your total portfolio, now when I mean total portfolio, I actually mean the cash and the shares that you actually have at any point in time, right? So if you were investing $10,000, right, you put $200 in a stock that's gone up 3 times, you're going to end up with 6%, right? Or 2 times 300. So 2 times 3 is actually going to give you 6%. So your 10,000 will only be up $600, right? And that's not going to be a huge. It's not going to make a huge impact on your total portfolio, right? On the other hand, I give you a downside. If you accidentally buy the wrong stock, and it happens to all of us, assuming it drops 50%, but if you had allocated 20% in your portfolio, you are actually looking at a total net loss of 10% in your total portfolio. So what I just want to illustrate to you guys here is I'm giving you two illustrations, right? The first illustration is this: if you had put 5% in a stock that's gone up 300%, you would have gotten a 15% return. If you put 20% and it's gone up minus 50%, you are actually down minus 10%. So really, in this scenario or illustration I've showed you, your net returns really is only 5%. We have to understand one thing, right? When it comes to investing, you are not just investing per stock. You are actually investing in a group of stocks, right? Which means we cannot only acknowledge those stocks that we have actually made money on. We also need to acknowledge and account for stocks that we've actually lost money for. So at the end of the day, and that's where I see a lot of retailers kind of get the habit that, I made money on this stock, but the one that I've lost money on, don't worry, I'll just hang on tight. I'm a long-term investor now, investing. And if I haven't sold, I haven't lost money, right? And then they end up holding the stock for the next 10, 15 years, right? That's really ideally what you don't want to do, right? So one of the things that you have to be quite agile with in your portfolio, you have to be quite detached emotionally. Even though it's your own money, I know it's easier said than done. Ideally, you want to be as detached as possible and to look at stocks and portfolio allocation very pragmatically. That means you have to look at it very logically. If this is taking a higher risk, I need to lower the amount, right? Because we have to understand this emotionally, greed is limitless. Okay, you're gonna say, oh, I took profit this price, then the stock price went up. Oh no, I missed the boat. I think there are many fishes out there. As you can see, we have over 900 over stocks, 700 over them are Shariah-compliant. So I don't think anyone should ever feel that, I've lost out, or I should have not sold, because it's almost impossible to tell you when the highest price is ever going to be unless it's in hindsight. Okay. So the real protection that you do have is really how you're actually going to construct that portfolio. The second illustration I'm going to show you here is if I swap the same stocks around, if I put 20% in something that gone up 300%, you would have got a 60% return. And of course, if you put something 5% has gone up 50%, you've got minus 2.5. So your net gain and net gains from illustration 1 and 2 is actually very vastly different. All I did was change the allocation between the first one and the second one. Right now, this is purely for illustration purposes, but I want to give you guys an idea, which means that for those of you who are watching the show right now, my guess is that you already have a portfolio. Okay, do you actually know what percentage of your portfolio in each stock do you have? If you don't do that exercise, you're going to see huge clarity in what kind of likely returns you're going to get in your portfolio. Okay, there's actually going to be another element that you have to look into is actually your cash. If you're holding a lot of cash and invested very little, if the market does run up, you're actually going to get very little, right? At the end of this, I'm going to talk a little bit about, what are possibly some of the trends that you should watch out for. Now that we are post-COVID and we are now living in a new normal, we have to go out, wear masks, right? I'm here in front of a screen, live streaming to you guys at home, right? And you guys are either watching your mobile or something. So we have, there are certain trends that we have to take into account, right? Will things ever go back to normal? I think it's hard to say at this point, but that's why we have to be quite agile with the way we think and the way we allocate in our portfolio. Okay, so I think this is a very classic one that I've always talked about in investing, right? I always draw kind of this parabolic curve to sort of illustrate to you that how businesses grow. Or how, it's almost like a business life cycle, right? So most companies always start up as a startup, right? Someone has an idea, they've got capital money, I start up, right? Business is not proven. We don't know whether the earnings are recurring or not, right? Of course, eventually they move into what we call an emerging grade company. The moment they've actually got a product that they are able to sell and they are scaling up, right? So when you're finding companies that have got a proven product or service and they're scaling up, that's sort of when you put them in an emerging grade category, right? Now, some stocks also tend to be, or some industry specific also tend to be quite cyclical in nature, right? And I'll talk a little bit about that later. And then of course at the end, if you reach the top of, or the Mount Everest, right at the top of the peak, you are actually looking at what we call an investment grade. Now of course these terms that I'm using is really the whole idea behind this, is that there's no hard and fast rules behind this. The concepts is just very simple. How are you grading your stocks, to sort of get an idea how much risk you are taking? That's it, right? Because if you have that, you know very well what kind of potential returns or losses you have built in your portfolio, that you actually can get. Okay, of course, a lot of companies that reach the peak. I think we have many stories about that. In business where complacency sets in. They get new competitors from outside, or they get disrupted by innovation or by technology, right? Then this thing called sunset sets in. Eventually, the whole idea here is either they shut down or they move into this phase called a turnaround situation, right? So a turnaround, if you notice right here that I've sort of covered it here, that's actually a question mark, right? So the turnaround is really a question mark. Can a company turn around, move back into a business that they can scale up again and eventually move to investment grade? Now, so when we move at different life cycles of the business, understand that time is not so much the factor here. It doesn't mean that if you're in business for 10 years, you're definitely going to be investment grade. That's not what the factor here is. The whole idea here is that there are different phases of business. At different phases, there will be different risks that is going to be associated in your portfolio, right? So either you want to call it 1, 2, 3, 4, 5, or you want to call it startup, emerging grade, cyclical, investment grade, sunset, turnaround, 1, 2, 3, 4, 5, 6. You can grade them, sort of give them a grade on how much risk that you're taking in your portfolio. We do this really to give you an idea, or to give us guidance, right, in how to actually construct a portfolio. And I'm going to go through that in a while, right? Now, most commonly, when I get asked, how should I construct my portfolio? In fact, in times like this, it's really not so much about constructing a portfolio, but really what stock to buy now, right? And I'm trying to give you guys a plan, right, so that you're not just fixated on one stock. Eventually, it has to be a group or basket of stocks that's actually going to help you create wealth over the long term. And if you look at it, I guess the most sort of common concept around this is that, hey, you know what? Why don't I just buy some stocks from every single sector, right? Of course, you can do that, and that's the very traditional approach. But here's the beauty of it. If you're a retail investor, you are not driven by any mandates but your own, which means that it is your own decision what you're going to buy and sell, which means it gives you a complete free hand in really how you want to construct your portfolio. So my takeaway from this is this: regardless of sectors, you're still going to find companies with different risk profiles, right? In a consumer products and services, you may find a startup, you may find a turnaround, you may find a sunset business, you may find an investment grade company, right? So you really need to still go back down. So we call bottoms up approach, which means that we actually can stock pick and kind of decide what kind of risk that we're willing to take to invest in what shares, right? Now, the reason why we want to get you guys to think about risk is this: if you are able to determine how high or low risk it is, that's going to be very much going to determine how much money you should be putting in. When I say should, right, this is where the discipline needs to kick in, right? A lot of us are quite indisciplined when we find a very, very sexy story. Like now, we get a lot of sexy stories, right? We want to put everything in there, right? And this is really to help you resist the urge and say, look, this is my plan. I've got X amount of money. I'm going to invest in 8 to 10 stocks. And this is each of them. I'm going to allocate a budget depending on the risk profile. Okay, this is a very simple way to do it. You don't have to crack your brain. You don't need crazy Excel sheets. All you need to do is plus, minus, divide, and multiply, right? So what I'm showing you here is that multiple sectors have multiple risk profiles, right? So if you are able to classify these stocks, means that you understand the business, all right? If you're not able to classify these stocks, means you don't understand the business. And if we talk about investing, investing is talking about invest in businesses that you understand. Okay, not someone else telling you, "Hey, go and buy this stock," and this is it, right? So every single sector will have different categories of stocks. Okay, so I put down very specific ones that are generally more cyclical in nature, right? Generally more. Okay, so these are the few that I've highlighted. These are the sectors, right? Energy, oil and gas, right? Generally, okay, in very general terms, you have construction, right? Which is something that I think globally, all governments around the world is gonna restart some form of shape of construction to quickly boost the economy. Uh, the third one is actually property. When I say property, very specifically in Malaysia, property developers. So piece of land, they develop it, right? And the fourth one is actually plantation, right? Why plantation? Generally a bit more cyclical. It depends on what they're planting in the first place. But in Malaysia, we have quite a few listed companies that are involved in palm oil, right? And their earnings are very, very much largely tied to the price of the commodity, right? So if you talk about if we had a very large mining sector and the mining sector was very much earnings tied to the price of commodity, that would also be fairly cyclical in nature. All right. This is just a very general sort of overview to give you guys an idea. So the idea why we want to highlight cyclical is this, right? If you're investing in them, don't think they're going to last forever, right? So which means they will have booms and they will have busts, right? Of course, the best time to look at them is when they are in the downtrend, or what I say, they are at the bottom, right? When the market's not hot, no one's talking about them. Those are down cycle moments. You're actually waiting for the cycle to reverse, right? That is the whole idea behind it, right? But of course, this is very general. You still have to go in through each of these sectors to figure out exactly what is it that they do, right? So for example, if you're in the energy sector and you're part of the service business, you're not as much exposed, or let's say you're in storage business, you're not as much exposed to oil price volatility, right? And you could be an investment grade stock, but this is a very general in nature. So you have to look at where the source of revenue actually comes from. That will give you an idea whether it's cyclical in nature. All right. Let me see. Okay, so how do you actually want to build a portfolio? So I'm going to give you guys sort of an idea, right? It's a rough guideline. Now, if your target is 17% per annum compounded, and I'm talking about compounded returns. I'm going to illustrate to you what I mean by compounding. It's actually going to be so this is my rough estimate. So if you're looking at a 17% compounded rate, you're actually going to be looking at 30% investment grade stocks, and you're going to fill up the rest of 70% of your portfolio in emerging, cyclical, turnaround, or startup stocks, right? If you want a 15% return, so my assumptions are based on this. My assumptions is that on a net basis, investment grade stocks can give you over the long term about 10% per annum, right? On a long-term basis as well, emerging grade, cyclical, turnaround, startups can also give you about 20% compounded. So when you mix them both together, that's really how you're going to get your KEGA target return. So how you construct your portfolio, it's going to be largely dependent on what kind of numbers you want to achieve, right? Of course, we want to achieve the highest possible, or what we call, inverted commas, maximize returns, right? But when you say maximize returns, means that we actually don't have a target, right? Or we have a moving target, which is even trickier, okay? And moving targets sometimes relate to greed, right? So, of course, if you're looking at 12, we're looking at, actually, this should be 13, sorry. It should be 70% more investment grade and the rest emerging grade, cyclical, turnaround, and startup as well. So how are you going to build your portfolio? So I strongly suggest, if you guys already have a portfolio, try and figure out what kind of risk profiling you're taking with each of these stocks. Look at the percentages, and this will give you your answer. If you do this exercise, you're going to get a very, very clear picture of where you stand, right? And that is the most important part. Before you decide to buy and sell or do anything else, really that is the first step that you want to look at, is that, hey, I'm now guided my portfolio to actually make some changes. Now, so I'm going to illustrate to you what I mean by compounded returns, right? So I've put 3% as a compounded return, and this is illustrative purposes. I'm going to assume that you've put in 50,000, and a compounded return of 3% in a fixed deposit, for example, for the next 5 years would actually give you a 57,000 return on your capital, which means your absolute return is 16%. Right? If you move up to 13%, you're going to see that number jump from 57,000 to 92,000, right? Which is a big jump to 84%. And then, of course, you move to 15%, 50,000 here becomes 100,000, and 100,000, so it's about 100%. Of course, you move to 17%, 50,000 becomes 109%. And of course, at 20%, you're looking at 124,000, right? My suggestion is this: if you're investing in stocks, and I say investing, not speculating, and you don't minimum have a 5-year time frame, and say you really need that money like in the next 6 months, I don't strongly suggest that you put in the market, because markets tend to be volatile, and from my personal experience, only when you need money when markets are down, right? When markets are up, you don't actually need money, right? So this is the whole idea here. When you want to construct a portfolio, you need to put money aside and leave it there for 5 years. And this is my recommendation, meaning that you should invest over the long term, right? And I just want to give you an idea. So if you had money, 50,000 sitting in FD, this is, if you hit some of these numbers, these are the possible returns, right? This is on a compounded basis. Understand that it's not simple interest, right? Meaning that it's not 50,000, 3%, and another 3%, and another 3%. This is interest on interest, right? So I'm going to show you something a little bit different. Now, there's a reason why I stopped at 20%. And later I'll share with you why I stopped at 20%. Why don't I put 25, 30, 35, 40, right? Now, so again, I put a $50,000 investment. But in this scenario, the only thing I've changed is that I put aside 500 per month in the portfolio for the next 5 years. So which means 5,000 a month over the next 12 months would be 6,000, right? So 6,000 times 5, you add another 30,000 in capital, right? Now, if you look at this, just purely by putting the FD and you're putting the ending amount, this is this absolute return. But if you look at this ending amount difference, right, just by putting 500 ringgit a month in your portfolio and not touching it for 5 years, this is your end amount. If you can do it at 13%, if you just put 50,000 and don't do anything, you're only going to get 92. But you're going to see how that difference actually starts compounding. So just by putting a little bit aside, you're actually going to see what that big difference comes to, right? Of course, you come to 15% at 100,000 becomes 141,000, right? And of course, at 17%, 109 becomes 151, and 121 becomes 169. So if you really, really want to supercharge your portfolio, number one, you have to be very disciplined, very, very disciplined. The whole idea behind this is that if you put in a lump sum, it doesn't matter how much you start with, but it's actually the consistent topping up in that portfolio that will actually make the difference, right? And this is the whole idea behind it, right? So if you can see, the numbers are actually quite big, and the amount is actually quite small. And this is all done during the same 5-year time period, right? Now, the reason why I've put 20% is this. If you look at Warren Buffett's long-term average, and of course, he's managing hundreds of billions of dollars. Warren Buffett's long-term average in the US market is just slightly below 20%, right? I think as of last year, it was about 17%, right? And he's considered the world's greatest investor. And when I say invest, I mean investor, not a speculator, right? So if you're actually looking at it from that lens, right, 20% is a huge amount, and he's already the world's greatest investors at 20%. What we are here trying to do here is that, look, if we're not the world's greatest investors, could we possibly achieve 15% or 13%, right? Because as much as we like to have very high compounded returns, we also need to understand that there are certain limits to how quickly you can compound your portfolio in how to compound your portfolio over the long term, right? So I know in the short term, I think maybe in the last 3 months, a lot of investors would have made a lot of quick money, easy money, right? I guess the question here is, are you able to do this continuously for the next 5 years, right? And that's the whole idea why you actually do want to set up a portfolio, right? Now, sort of post-COVID, these are my thoughts. These are my thoughts and my personal view into, what do you think it's likely going to happen post COVID-19. Now, let's focus on what we already know. We know a few things. We know most countries are in what we call a technical recession, meaning that GDP growth numbers have shrunk in 2 quarters, right? I don't think any country today is actually spared. I don't think any country today is spared from this thing called technical recession. Of course, what we know now, our governments are trying very hard to stave this off through the creation of more currency, directly giving it to their citizens through a number of tax breaks, through loans, right? That's what we know, right? We also know that governments are also going to be the solution provided to the situation that we're all in. Of course, in Malaysia, we've all been given, borrowers have been given a 6-month moratorium, right? Of course, now it's been further extended beyond extra 3 months for targeted moratoriums, right? So really, I think the government policies now are really the best fight against the economic recession that we are now in. Okay, that's what we already know. Here's one thing to add to that, right? If you look at all recessions, not every single recession compared to the past will ever be the same, right? You're not going to get the repeater one. 2008 was different. 2020 has been different. Okay. So the question here is, what should we do if the markets are down, right? So markets are going to be volatile. That's my prediction in the next couple of years, right? However, if you look at very long-term studies, right, and this was done back in 2015, right, they actually did a study back to the 1800s, and they actually looked at the US market. This was what they figured out, right? On average, bull markets last 5 times longer than bear markets. So, for example, a bear market on average is 14, 18 months, right? Which means from 2008, if you look at the last recession, 2008 to 2009 May, right, it was probably about 14 months. Markets started to improve post 2009. We've actually had a very long bull run, almost 5 years, almost 10 years, a decade of bull runs, right? Which means, what it means is this: if you are invested over the long term, and you are able to take the shocks, right, the short-term shocks that we have or experiencing, okay, if you stay in the market rather than trying to time the market, right, one empirical evidence is this, right, bull markets are going to be 5 times longer in time frame. Now, so what it means now is this, right? So we are now in a recession. Of course, markets are up. Some stocks are up, right? Let me remind you, a lot of stocks have gone up, but a lot of stocks are still down at the moment. So going by this article, what it could mean for us post COVID-19 is that if we are now already in a recession, the next thing that's going to come is a recovery, right? With a recovery will come a bull market as well. So if you look at this, if I go by this definition, then we are now in the very early stages of a bull market, right? Of course, that is for you to decide. But if you look at the stats, this is what it's going to show you, right? Of course, if I knew what the market's going to do in the next 3 months, right, I won't be sitting here. I'll just look at my crystal ball and do the exact same thing. Unfortunately, that is not realistic, right? I don't have a time travel machine. So going by stats, we are probably very, very early on in a bull market, right? And this is a global thing. The second thing post-COVID-19 that I think investors must look at or to be guided by in their portfolios is this: tech trends, right? Tech trends are going to be even more important in the next 2 decades Now, why do I say this? COVID-19 has essentially accelerated digitization. It's just accelerated. It's put it on turbo mode, and if really in that short span, people are forced to do things digitally, because there was no other choice because of social distancing, right? Or now physical distancing they talk about, right? So what is going to impact your portfolio in the next decade to two are going to be very, very important technology trends, right? And if you can catch some of these stocks, right, they're going to give you some pretty good returns in the next decade. So in a very large term of trends, right, of course, I don't like to throw buzzwords around, because, sort of every, article that's written this kind of right buzzwords, you still have to go down to that stock, right? You can't throw things around like Internet of Things and then say, yeah, let's invest in Internet of Things, but it's so wide, right? Where specifically are you going to be investing in? So here's the take, right? If you're investing in businesses that are finding it difficult to change or have been very, very much affected by digitalization or refuse to digitalize, right? Or unable to pivot their business to digitalize, for example, they will suffer, right? And this is not just post-COVID. I'm talking about very, very long term. I think all business owners today need to seriously rethink their business model, either change or actually be changed, right? So there are going to be major technological breakthroughs, and with major technological breakthrough, what happens is consumer behavior will change as well alongside, right? So we can't look at the past tech to kind of say, yeah, this is where we're going to go forward. But technology trends are going to be a very, very important staple in building your portfolio going forward, right? So go read up about tech, right? You have, I don't think any business today, big or small, can actually survive without any form of technology, right? So look for people who are able to solve problems with technology, right? Of course, those who are able to use technology that applies to the business as well, right? That is going to be a very, very important aspect or focus of building your portfolio. More important, I feel, now in the next 10 to 20 years, that there has ever been in the last 10 years, because in the last decade or so, or last 2 decades, if you look at the year 2000 when .com kind of went bust, that was really 20 years ago, and the internet has changed a lot in the last 20 years. And what has happened in the last 20 years is really setting stage for what is to come, right? 20 years ago, a lot of this cannot have happened, right? So it took 20 years to build infrastructure. It took 20 years to build software. Took 20 years to build supply chains, right? Really now, I think we're kind of at a cusp where everyone has no choice but really to adapt and adopt some of these technologies. So we've now built that platform over the last 20 years, right? We're still very, very early stages. So you have to kind of, and I believe going forward, accounting numbers will also have to change according to these, right? To actually recognize digital assets in terms of values, right? That they will bring to actually businesses as well. All right. This is the last slide, Benny. Do you want to get them to download or share anything, Benny?
Okay, so guys, if you want to download the slides for today, you have to fill up the evaluation form, which is on the next slide, Alvin, if you may.
This one?
Yeah. So just fill up the slides. Just bit.ly/Bursa Sharia, right? Once you have filled up that form, about a few days, we will send you those slides in your email. So make sure you enter your email correctly. All right. So we'll put this link in a short while on the comment section so that you are able to click on the link to fill up the form first, and then we'll send you the slides into your email. All right. So if you have any questions, you can type it right now. If you want to ask any questions to today's topic, which is building a portfolio. Now, but before you ask the questions, maybe I want to ask you guys some questions first, just to get a gauge of what kind of investments you're doing. How many of you already have an investment portfolio? Right? If you have an investment portfolio type one, right? If you have not built a portfolio, you just type two. All right. So one, already have a portfolio. Number two, you haven't built one. Okay, there's no number three lah. Number three, maybe you have, but you don't follow, or you don't really use it. So it's either you have or you have not built one, because like Alvin mentioned, in order to really be consistent and to achieve your investment objective, you has to be having a portfolio, right? And I think, right, in the past few months as well, I mean, you can buy any stocks, right? Of course, mostly related to the COVID or health, or glove making or whatsoever. You could have made a lot of money, but question is, are you able to make this in the long run, right? Because we have also seen so many people who have made some money. They think that this is it. They have found the right formula, and only to lose all the money they made earlier, right? Because why? Simple. They don't have an investment portfolio. All right. So you need to know how to manage risk, and especially a portfolio that suits you, right? And of course, if you have missed some of the sessions earlier, you can always go back, because there are a lot of other asset classes that we have gone through, including ETFs and REITs, and even exchange traded bonds or sukuks, right? For those who do not who cannot take risks a lot, one, right? So yes, you really need to find a portfolio. I think one of the key takeaway that I can get today is, you need to know the business. I think it's very important. You need to know what category that stock belongs to. Then only I think you can build a portfolio, right? Because we do not want to build all the portfolio with startup companies or turnaround companies, right? Then your risk will be very, very high. So if you have not built a portfolio, even if you already have stocks, but you haven't really built a portfolio, categorize your stocks first. I think that's the most important thing. I think that's one of the things that you have to identify first. All right. And then slowly you build that portfolio, and make sure you have a balanced portfolio. Okay. Yeah. So we see that it's mixed, right? We have like probably half of those who responded has a portfolio. Okay. And half of them have not built a portfolio. So fantastic. You're in the right session today, right? So those who haven't built one, so please start to build a portfolio. Make sure that portfolio suit you, right? I know there are, one of the things that Alvin today as well. There are many people who have gone out there. Even some people becoming experts in a market that shows returns, in the short term. But I mean, based on experience, right? We've seen people come and go with this kind of market, right? In the bear market, in a very tough market, you don't see them around. But in good markets like this, suddenly they sprout out like mushrooms, right? Um, I mean, you have been investing for a long time. I've been doing it for quite some time, right? And I think one of the things that really what makes us survive and grow in the market is to actually have a portfolio. And again, it can be an aggressive portfolio, it can be a conservative portfolio. It depends on your risk profile, right? So what do you think, right? Before I know, because you have started learning from your dad, who actually started investing and started to get the data, and so on and so forth. But what would you be doing today if you have not built an investment portfolio?
Me, what would I be doing if I'm not built an investment portfolio? I actually I have no idea. For me, I like stocks, or I like investments. Purely as a passion, right? So that's something that I do, and I still continue reading up. So you're gonna find out there's so much stuff that you actually don't know, that you have to keep digging and learn more from it. Yeah. And
Right.
also, maybe for the viewers out there, the 6 categories of stocks, is something I use as a guiding point at Equities Tracker. It is by no means a fixed definition, but I just want to get you guys to think in that framework to understand what kind of risks are you taking in your portfolio, right? Because that will largely it will determine your return as well. Yeah.
Yeah, my experience is it because I start off as trading first, right? And trading is like you buy and sell, you buy and sell, and basically you don't track whatever stocks that you bought, right? And we always remember the current ones. Like if you have made money right now, you made 50%, 100%. But if you look back at the history, we probably haven't made money because we've probably lost that the number of trades that we done earlier.
Yeah.
So I think one of the important things in having a portfolio is to really see realistically, right, whether you are actually making returns from the markets, right? Because all the records are there. I think that's very important. Because right now, if you ask me, if I don't have a portfolio, and thank God for Equity Tracker, actually you have the portfolio system for retail investors, right? Because during that time, about 10, 15 years ago, if I want to get a real investment portfolio, I have to go and subscribe to things like Bloomberg or Reuters, which costs a lot, right? Only institutional investors are able to afford it. But right now, I have, and once you start to really develop a portfolio and put all the stocks into your portfolio, then you can really see what kind of returns that you are really getting, right? And,
Yeah.
and most importantly, also to actually see what all the mistakes that we have made, yeah, all the right decisions that we make, so that we can actually learn from it, right? So that's why I think if you don't have a portfolio, I really suggest that you start one right now. And for those, of course, who are looking for Sharia compliant stocks, number one, make sure when you buy or invest on that stock, it is Sharia compliant, right? And you can find whether it's Sharia compliant by going to bursamarketplace.com, right? And you can actually see on that counter when you look for the counter, and it will tell you whether it's Sharia compliant or not. All right. Well, Shafiq here says they don't even have a CDS account yet.
Right. Go get one. It's I think it's only 10 ringgit or $10.60, right? But you have note that a lot of brokers have a backlog in opening an account. So and go out there and open an account. It doesn't cost you much. Get started. I think that's the most important thing.
Yeah, that's the first step. I think everybody have to take. Yeah.
Yeah.
Okay, we have a question here by Teo Giap Singh. I'm just gonna put the question up here. Should we diversify in building a portfolio, or should we just opt for a more concentrated portfolio? On one hand, people saying don't put all eggs in one basket. There are views saying that put all eggs in one basket and watch the basket carefully.
Look, I'm not a big believer of put all your eggs in one basket and watch it carefully. Uh, what can you do? You just watch it, right? You don't really know what's going on in the business anyway. I mean, as a retail investor, so I think it's quite impossible to actually watch the basket carefully. Um, I also like to add that diversifying for the sake of diversifying is not a solution, right? You would so I give you some rule of thumbs, right? So you would want to do, you probably don't want to exceed that 20% mark for one stock in your portfolio. So, for example, if you're only putting 20%, and that's to me, depending on the size of your portfolio, that's fairly concentrated. You're only looking at 5 stocks in your portfolio, right? So you got to figure out how many stocks can you genuinely monitor well enough. When I say monitor, you talk about quarterlies, talk about industry, talk about the business, right? How many can you actually realistically, with the time that you have, can you monitor, right? So if you say 10, then you could be a 5, 10, 15%. So one of the things that you want to do is don't watch the limit of how much you're going to put in, because I can tell you this thing, right? Markets are very bullish today, but when a correction comes, you're going to be so thankful that you stuck to some of the limits that you put in, right? Because it is actually quite difficult to cut losses, right? So most people will just see their profits go back all the way down. So that's something that is actually quite important, right? So don't diversify for sake of diversifying. I think create a portfolio that you are comfortable with, right? If you're very comfortable with one stock, which I think is probably in the realm of a bit more speculation, I'm not to say it's wrong, but it's very much your comfort level, right? Like what I do is a diversified portfolio, right? Not a diversified, just for sake of diversifying, but a portfolio which has several stocks, right? So you're not going to get the maximum return, but you're going to get a fairly well balanced portfolio. So you have a mixture of investment grade, emerging grade, cyclical, turnaround, and sunset. Not sunset, but you have a mixture of stocks in there. And if you have a couple of turnarounds, I have a turnaround in there. You put 5-10%. If it goes up 5-6 times, that's a huge return, right? But if it goes down by half, you only lose 5% your portfolio. So really, that's the whole idea behind it. It's trying to be quite defensive, and the idea really is about risk-weighted return, right, in your portfolio.
Yeah, so I think that's the idea about portfolio, right? Like you mentioned earlier, let's say you bought a stock which is just buy one stock, right, which is 50,000 ringgit, and it goes up 4 times to 200,000 ringgit. You feel happier about it, but when the next time when you invest, it's not going to be 50,000. The next time you invest, it's going to be 200,000, and you continue to buy one stock again. And imagine if that one stock fell 50%, not go up 400% like you initially did, but even if it just go down 50%, that 200,000 become 100,000 ringgit. So that volatility is really huge if you're just concentrating on one stock, right? But if you have a portfolio which is balanced, and of course not too diversified for the sake of diversifying, like what Alvin said, because if you put 100 counters in there, then I don't know how it's gonna perform, right? So you really have to be selective, and of course one of the challenge is also to be able to pick the correct stocks into your portfolio, right? And of course we have talked some about this earlier in our earlier session, how to find investment grade stocks and so on and so forth. But really, you need to have a method or an approach to identifying stocks, not by gut feeling, not by luck. All right, I think that's very important for consistency. Now let's go on to the next question. Let me see. I have Daniel's asking how to do well in timing risks and topping up consistently since the prices are volatile, or rather, at least now being so bullish.
Okay. How do you do well in timing risk, topping up consistently? So, because you don't know what's really gonna happen. So my only advice to you is this, right? Markets are volatile, which means that price will swing up and down, right? Which is good, right? Volatility is good. So the idea here is if you have a budget of, let's say, 10,000 for the one stock, you wouldn't want to buy all 10,000 at one go. You spread it out over time, right? So some rules that I do follow: if you plan to buy up as the price goes up, you just buy less than what you buy when at the lower price, right? That is one technique to protect your capital. Similarly, if you're buying a stock and the price comes down, and it's a good stock and you're investing, you want to buy some as it goes down. All right. But right now, if you want to be very defensive in a very bullish market, then you would buy, as you buy up, you would buy less than what you bought before. That's the general idea behind it. You'll never get the best timing, right? It's close to impossible to buy at the lowest and sell at the highest. So really, one of the things that you can do in the bullish market to control that greed is actually to have a target price and then actually stick to it, right? Forget about, even if it goes up 3 times after that, it shouldn't matter to you because you have so many other opportunities as well.
All right, now we have a question here from Mailing. Guys, we only have time for 1 or 2 more questions, so you've typed in your questions right now fast, because we're going to end this very soon. All right, so please do type those questions as fast as you can. We can only answer 1 or 2 more questions. So now, next question, Mailing is asking, what's the best stock strategy during a market correction? Do we start selling or hold on to good stock?
Best strategy during a market correction. Well, if you subscribe to this thought process, right? So there's a few ifs to this. Okay, so assuming that your stock is still quite undervalued, for example, then as a market correction, I would buy some more, right? Assuming that I've not exceeded my portfolio allocation. Okay, that's the first one. However, if your stock has been largely overvalued today, it makes sense to actually lock in some profit. It would make sense, right? And just understand this, right? It's never wrong to take profit. I think a lot of people are afraid, when's the best time to take profit? You know that there's never going to be the best time. You're never ever going to know, right? But you're not ever going to be 100% right in taking profits. So what you want to do is kind of spread, when you start taking the profit, spread it over a few prices, right? Or you just key it into your system and just leave it, and then it will execute by itself, right? So that's really the idea behind it, right? Uh, I would actually do the contrary, not actually start selling when there's a market correction. If it's a good stock, I would actually top up some more, right? If you agree with this article, right, that I've talked about, and you're saying that it is a correction, right? The biggest thing that you have to do is not be afraid, right? Which means that you know that bull markets last 5 times longer than bear markets, which means that if it's assuming it's not undervalued and it's gone down in market correction, then if it's a good stock, I would buy some more because I'm building an investment portfolio, right? If you do believe this idea that we are in the very early stages of a bull run.
Do you believe in setting short-term targets, like a 1-year target instead of a 5-year target? Which one we think will be more better or better?
I think setting price targets would be better, but you have to definitely, if you're investing, you definitely have to look at the business is in, right? If the business is improving, you cannot use your old target price, right? So you kind of have to change that target price. But I rather not go on time, but more on the valuation itself, right? And typically when stocks start moving, right, they will take some time to build up and sell and move over time, right? So just as you have been very patient down, you have to be equally, if not more patient as it goes up, so that you don't lock in profits way too early.
Yeah. Yeah, I think following that profit target is very important, and because before this whole COVID thing, the market started to really rally in March and April. I mean, since 2018 to year 2020, right, these 2 years, if I can make a 10% profit in the short term, I mean about 2 to 3 months, I'll be actually quite satisfied with it, right? But right now, if you look at those stocks that move like 30-40% in not just 1 week or 1 month, but 1 day, right? It seems a little bit crazy, right? But I think that, like I said, I think I agree with you completely, is because you really need to set your eye on the target, right? And I think that's, for me, that's a very important roadmap for you to follow, so that you don't get diverted, right? Because if I were to be greedy right now, okay, and if let's say in the future, let's say in the next 2 or 3 years, when all of this, all this frenzy has already finished, and I start to have this greed, right? Because the greed that we have developed right now, and trying to get the 30% profit, 50% profit, or even 100% profit, and I will use this in a really difficult market, then I will be in trouble, because I look for high profit, but it never go to the high profit, right? So yeah, that one, I think that's very important. So you have to put really your eye on the target. That's not, whether you are trading or investing, is the same thing. Okay. Okay, last, maybe 1 or 2 more questions. We have 2 questions here. Last one. There's a question here from Lee Kyung Po. What is the same thing? What is the right time to lock in your profit?
I don't think there's a right time to sort of lock in a profit. I don't think there's ever going to be a right answer. You see, here's the thing: when market correction, all good or bad stocks will also drop. You're right, but here is the clincher. When markets recover, only the good stocks will recover. The bad stocks may stay down, and maybe stay down for a long time, right? If they are highly speculative in nature. And that's why in investing, we only stick to good stocks. Right. So really, they always have this term, never catch a falling knife. But I think in investing, we're really looking at, yes, good stocks will also fall, but they have a more higher probability of recovering, right, than a bad stock ever will, right, in the longer term.
All right. Okay, one more last question, and this is from Irene Tan. What should we do when the stock has additional listing? I'm not sure about this additional listing, though. Additional listing meaning it's listed on another market?
Yeah, it's another market, another a warrant that's listed, or has it been a demerger where they listed or they split their companies? I don't know. It depends. I mean, hard to answer that question. But so if I had a segment for warrants, which is very much price based, I would put those warrants at, depending on how much time decay or how much time expiring. I typically will put warrants in a higher risk segment, right, rather than lower risk segment. Yeah.
Yeah, Irene says it's the same market, but same market means I assume it's warrants because you can't list your company twice in the same market.
Yeah,
Additional
I
share
think that's additional shares, right?
or
Bonus
bonus
issue.
issues. Everybody's asking the question now
I
to
don't know.
Irene.
I don't know answer.
Uh, yeah, to be a little bit more specific in your question. Yeah, Irene, give you another 5 seconds to come up with a more clearer one. Or if not, we have to end this session right now.
Yeah.
Okay, so, guys, the others, you don't have any questions? If you don't have any questions, then maybe we can take Irene's question later offline. We'll answer them in the comment section. And guys, don't forget to ask the question. Fill up the evaluation form to get the slides today. All right. So just go to bit.ly/Sharia, Bursa Sharia. Sorry, bit.ly/Bursa Sharia. Fill up the form, and you should get those slides in about 3 or 4 days. All right. So thank you, Alvin, for joining us.
Yep.
And this is the last session, and you are at the closing session for
Yeah.
Bursa Malaysia-𝑖. And
Yeah.
do
Thank you,
stay.
Buster, for sponsoring this segment. Yeah.
Yeah. Thank you, Bursa Malaysia-𝑖. For sponsoring this session, and you know what? We're also going to have actually a mentoring session for Sharia-compliant investment stocks. So stay tuned on our Facebook. We will announce it on our Facebook how to participate in this mentoring session, right? So please do like and follow our Facebook page. So when we put up the notification, you can get alerted and notified. All right. So please do stay tuned. We're going to start this in probably 2 or 3 weeks time. And it's going to be sponsored by Bursa Malaysia-𝑖, so you can participate this mentorship program for free. Okay, not free, it's being paid by Bursa Malaysia-𝑖. Okay, so thank you very much, guys, for joining us tonight. I wish you all the best in your investment journey, and hopefully you are able to build an investment portfolio that's going to achieve your objectives in the stock market. So thank you very much once again for joining us. Have a good evening.
Thank you. Bye bye.